People are tired about hearing about these Americans and their SBA deals. They want to know how to finance a deal without the SBA. That's what we're going to be talking about today. And if you are an American, don't turn it off. There is going to be lots of information for you to take out of today's video. I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win. All right. So over the course of the summer, of course, I put out a whole video series about Get Into Business 101 is what it was called. And we created a special playlist for those videos. We'll put a link to it in here. One of the videos that we put out, number 7, was about financing. And it was called Get Into Business 101, episode 7, Due Diligence, Financing, and Getting Investors. So somebody watched that video. Let me scroll down here. Yeah, it was Funky Bro 29. Hey, Funky Bro, thanks for tuning in. It says, David, can you do a video on how Canadians or non-Americans structure deals without the access to an SBA loan like they have in the US? A lot of research on deals is usually done in the States where you have access to the SBA loan. Yeah, so true. A lot of the content being produced about this small business space is all about using the SBA loan, which is a great tool that Americans can take advantage of for buying a business in the U.S. And that's just one part of the SBA loan program. There's also all kinds of tools for people that want to expand a business, buy buildings, all that kind of stuff. And so, yeah, lots of financing flexibility. I have also observed directly that the availability of credit also increases the prices of businesses. So we're not going to get into that today. So what we're going to get into today is a conversation about how you do deals without any kind of, government loan program. Now, there is a government loan program for small businesses in Canada. And so it's called the Canada Small Business Finance Act Loan Program. It's administered by Industry Canada. And basically what happens is you go to one of the large banks or a credit union in Canada. Even some leasing companies are able to access this program, and the government provides a backstop or guarantee to those loans. And so I've scrolled down the page here to the part that talks about funding limits. So basically, it allows $1 million of loan guarantee opportunity, but really you can only get the full $1 million if your deal involves real estate. So there has to be a piece of property involved in the operating business to take advantage of the $1 million cap. If there's no real estate, then effectively the program caps out at $500,000 is sort of the cap. And within that cap, up to 150,000 can be used to finance intangible assets and working capital costs. So these would be goodwill. You might also cover franchise fees in there if you were using one of these loan programs for buying a franchise, or transfer fees for a franchise or something like that. Or it says operating capital, working capital. So there are banks that will issue lines of credit, for example. They'll use this program to backstop or guarantee the line of credit. So, and those changes with the intangibles are fairly recent, just in the last couple of years. So in Canada, when people are doing these deals, a lot of the times when you go to one of the major banks, and there are 6 big banks in Canada and a whole bunch of credit unions, they will do a small business loan. They'll use this program for an added layer of guarantee. Now, they also have to undertake their normal underwriting process, and they have to try to secure the loan as best they can. So expect to sign personal guarantees, except expect that they will put a lien on fixed assets and various collateral, et cetera, in order to do this. And so in Canada, you can buy a business, you can use this loan program. The other big financing avenue that we have in Canada is a special bank owned by the government called the BDC. And the BDC is more of a cash flow lender. They will also do loans against like buildings and stuff like that. But they are the ones who are going to consider sort of the cash flow aspect. And I have seen many, many, many deals done in Canada where the BDC and one of the big six charter banks are both doing some aspect of financing the deal, and they're actually working together to divide up the financing for the deal. So we're going to get into a broader, more general formula here for financing, but I just wanted to make sure that you understood that there are these options available. Now, in my research, I also poked around some other places, and guess what? The British Business Bank is also come on the scene with a program that reads a lot like the Canada Small Business Finance Act loan program. And this is something that has just literally come into force in July of 2024. And basically, they're offering guarantees through other British banks that are going to be actually making the loans. And they are saying that it's up to £2 million per business group. So that's actually quite a higher limit than the Canadian program, considering that a pound is worth more than a dollar. Um, and then it also says here, there's a sort of a variance here, I guess, for Northern Ireland, but there's personal guarantees required. Decision making is delegated to the lender, and they are going to support term loans, overdrafts, asset finance, invoice finance, asset-based lending facilities, etc. So it sounds very similar in that a lot of this is going to be geared towards financing stuff rather than financing, goodwill or intangible value. So, what is then the normal formula for putting together financing when you're going to buying a business and you want to kind of ignore all of these loan guarantee programs? We're going to kind of take this in broad strokes. And here is where Americans, you're also going to want to listen because there are all kinds of deals that are done in the United States without SBA loans. And people will often refer to them as conventional financing setups for deal making. And why would somebody want to do that? Well, the SBA loan program has a couple of pretty specific requirements in that there has to be personal guarantees from the business person, and if there is not enough collateral in the business to cover the entire loan, then the SBA lender, the bank doing the loan, has to put a lien on your home residence, your personal residence as well. And so if somebody has a net worth of 100 grand and they want to borrow $1 million, they usually don't care that the personal guarantee and these liens are applied to them because they're getting so much value out of that SBA loan program that you know, they really are just willing to sign everything up and do the deal for the opportunity of acquiring the business. But if you have a net worth of $3 million and you have $1 million of equity in your home, free and clear, and you're trying to do an SBA loan for $1 million, you may not want to sign all the personal guarantees and let them put a lien on your house, especially because the SBA loan is, because it's a government guaranteed loan program, is at a certain interest rate plus several points. I've worked with many clients in the States who've said, hey, if I just borrow conventionally, like instead of doing the SBA loan, if I just get a line of credit on my house, for example, I can borrow cheaper and all my same assets are at risk. Or maybe it's even more secure because they just have to pledge that one asset, their house. So if you are looking at expanding your deal making tool chest, pay attention because we're going to be talking about this. So I dug through some of my past trainings and presentations, and I dug out this slide that I put together and modified a little bit for a presentation that I did last year in Charlottetown, Prince Edward Island. So on the screen, for those that are listening, I've got two different columns, one on the left, one on the right. And the column on the left, if you want to imagine sort of Lego bricks stacked on top of each other, it basically describes the stuff you need for a business when you are acquiring a business. So we can divide what is required to make a business function into three broad categories. So there's capital or fixed assets. So these are vehicles, machinery, real estate, shelving, cash registers, all that stuff that you need to make your business function. So that's one big block. And these are the tangible assets. Above that, we have a category called operating capital. So this is cash, accounts receivable, inventory that you may require to make the business go. And then on top of that, we've got something called goodwill, which is simply the difference between the price you're willing to pay for a business and those tangible things that you can put your hands on. So when you make a deal for a business, you are going to end up with a business entity, whether you do a share or an asset sale, you're going to end up with an entity that is ready to function that will include all three of these things. Your deal specifically with the seller may not include all those things. So you might just be getting the capital and fixed assets and the inventory and the goodwill. You may not be getting the cash and the accounts receivable. It doesn't matter. You're still going to have to inject extra capital into the deal. So it doesn't matter who you give the money to. It doesn't matter if you give the money to the seller or you put the money into your own new entity. This is all the investment. Okay. The investment for getting into business. So then the next question is, how do you fund the investment? And that is what is described on the right hand side of the screen here. So similarly, we've got another stack of blocks, but there are four blocks. And you will notice that the bottom block says leases, mortgages, and loans. And that block, if you look directly opposite on the left hand side, is related to the capital and fixed asset block. So usually, if you're going to buy machinery, equipment, real estate, etc., bankers are going to look at those assets and they're going to express an opinion, usually as a percentage of the value of those assets that they're willing to lend. So a banker might say, we're willing to lend 90% of a building's value, or we're willing to lend 75% of equipment value, or whatever their rule happens to be, whether or not they're using any of these government guarantee programs that I've just mentioned. Um, even I talked at length with a guy with a lot of experience in business in Peru, and he was telling me that he knew what his banker would do in Peru, and so there was a certain percentage of the value of these tangible assets that the bank would lend against, just because of the bank's security risk understanding, etc. So he had a good profitable business, but they still wouldn't lend him, for example, more than 75% of what a vehicle or a truck might be worth. So that leases, mortgages, and loans block is the first block, and it's related to these capital or fixed assets. And so that's the first part of building your stack of financing. This is, people talk about capital stacks and how your balance sheet is organized. That's what we're doing right here. This is directly related to that. So the first block, leases, mortgages, and loans, things you can get from bank. This is the cheapest form of capital, the cheapest form of leverage, and you are going to get this from institutional lenders or leasing companies, and it's going to be related to the value of those fixed assets. The next block above that is skinnier. It says revolving credit, and so this would be credit cards, lines of credit, that kind of thing. And it is related to the second block on the left, which is the operating capital block. So remember, operating capital is made up of cash you might have in the bank, accounts receivable, and inventory. Well, if the business is solid enough and has a good enough track record, and if certain conditions are met, like if your accounts receivable is all fairly good, it's all within 30 days, or your inventory meets certain tests, like it is what we call fungible inventory, meaning that it's not going to go bad, it's not going to go out of style, it's not going to rot, and that it is pretty, consistent in the industry. So I always like to use the example of two by fours at a lumber yard versus ladies' dresses, right? So a two by four is a two by four, and if you ever went out of business, those two by fours would be bought by any other lumber yard and put on their lot, and they're just as good as any other two by four. Versus the ladies' dress, where you've got a variety of sizes. The most popular sizes are going to sell first, and then at the end of the season, they're no longer in style or what have you. And so that's a poor example of a kind of inventory someone is going to lend money against, a bank anyway, right? So we have this revolving credit block, which is the small thin block. So depending on what the operating capital needs of your business are going to be, you may qualify for some of these operating or revolving credit facilities. The third block above that says your cash, right? So this is the money that you are bringing to the table, and this is your skin in the game. This is literally the equity, right? So if you think about your balance sheet, this is owner's contribution. Now, owner's contribution doesn't necessarily mean the entrepreneur's contribution. So don't get all in a knot and say, I'm going to get investors or whatever. Like that would be in there in your cash. So whether it's you or you and your buddies or you and your dad or you and your investors, it is the business owner's cash that is being put in. And this is what, gives the bankers confidence that you are committed to this deal and that you're going to make this work. The last block at the very top is the seller financing. Now, I want you to observe that the seller financing block is just a little bit bigger than the block it corresponds with over on the left, which is the goodwill block. Okay. So, because bankers are only going to want to lend a certain percentage of fixed assets, the leases and loans block is going to be shorter than the fixed asset block because they'll only ever lend you a percentage of accounts receivable and a percentage of inventory. The revolving credit block is always going to be smaller than the operating capital block. And your cash is sort of the mortar that fits between these blocks that helps them add up. But the seller, if they've got a profitable business that they've delivered and they've convinced you that the business is worth more than the value of the tangible assets within the business, basically they've said, look, my thing is worth more than just the stuff because it's awesome and it produces this cash flow. And if you buy this business, it's going to do the same thing for you. Well, that goodwill component, the intangible aspect of this business, we want the seller to finance that and probably even a little bit more than what that number is, right? So that's kind of a bare minimum. So this deal that is being portrayed here, um, this is sort of a deal that describes a business that has a bunch of equipment and inventory and a little bit of goodwill. If we were looking at a service business, like if we were looking at a maid service that owned a couple of little cars and some vacuum cleaners, and we would want that goodwill, or sorry, rather, the goodwill block would be a much larger proportion on the left-hand side. And so we would want the seller financing to be much, much bigger than what we see here. And just because we can't get the financing from traditional lenders, because there just aren't these tangible things to put their hands on. So in the on the right-hand side there, I kinda tried to make the your cash part be about a quarter of what is there. Because what I've learned over the course of my career is that in a lot of different places and a lot of different countries, I've talked to people all over the world, when there are no government guarantees involved, bankers seem to default to a certain threshold of risk appetite, and that certain threshold seems to be a 3-to-1 debt to equity ratio, which means that they like to see the entrepreneur or the owners of the business have about a minimum of 25% of their own equity. Now, if you're buying real estate as part of your deal, that could change because some of them will go further with credit against real estate than they will with other assets. But in the overall picture, they often like to see about a 25% equity position, which means 3-to-1 debt to equity ratio. Um, and so that's it. Like that's the formula. Now, if there's no bank involved, right? Let me hide this for a second. I want to go back to full screen. So if there is no bank involved, like all the rules that you just saw in that slide were based upon what bankers are willing to do. And if you are not using a bank, all of those rules I just said to you about debt to equity ratio and how, certain things are a certain percentage of the other block on the other side, all that kind of thing, all that just goes out the window, right? If there's no bank involved, there's nobody then dictating what you can and can't do and what the balance sheet of the company has to look like. And so what does that mean? Well, you know, if you could, for example, say to a seller, I'll put 10% down and you finance the other 90%. Like if the seller's agreeable to that, then yeah, you can go ahead and do the deal. And deals do happen like that. Usually not for the best businesses, right? Because if somebody's got a really good, solid cash flowing business, there are usually other people willing to make offers that are more palatable to that seller, right? So if you're more curious about these non-bank deals, I would suggest you check out my 2022 Summer of Alternative Financing playlist because I basically did a whole summer series about alternative financing. And the danger, of course, with those is that alternative financing opportunities tend to have higher costs attached to them. And so I have seen people successfully do acquisition deals where they've patched together a whole network of these different alternative financings in a band-aid or duct tape solution to do the deal. And a lot of these solutions tend to be shorter amortization periods and higher costs. And the issue that they run into, of course, is that they just end up in this really tight cash flow position if their deal cash flows at all. And I've seen people do deals that didn't cash flow because they were so eager to get the deal done that they didn't take care of what I call the day two problem. So I hope that this answers your question, Funky Bro, and I hope that everyone else got to take something valuable out of this because deals are done like this all the time. And I will, I understand fully about the whole attitude or the comment that Funky Bro said about how all he seems to hear about is these SBA deals. Um, just remember when you're listening to social media there is a couple of things going on. Number one, there are people that make their living doing SBA loans. And so they're out there like trying to create conversations about it because it's how they promote themselves. They're trying to drum up business. I mean, I've had guests on my own channel here in live streams who are SBA funding people, and that's their job is to get people into that loan program. The other thing that is alluring about it is because they offer such high, loan to value amounts, such high degrees of leverage, without a changing cost, right? And I've talked about this before, where nowhere else in the world would you be able to finance a deal 50% at a certain price and then finance it at 90% at the same cost of interest, right? So there's an inherent subsidy there, which really causes the return on equity to get jacked up. And that makes for exciting and interesting deal stories, right? So yes, you can hear a lot of really great stories about people that do these deals and the successes they have. The other thing I want to point out is that there's a serious issue of survivorship bias in online content, meaning that people that do deals and then fail miserably usually don't then appear on podcasts to talk about their story, right? And but I get to meet them because they reach out to me and they ask me for help sometimes about, how do I navigate this terrible situation I'm in. So so be careful with your deal making. I mean, one of the things that I like about sort of conventional or this sort of normal deal structure is that it does bring discipline. It forces you to have more equity. That usually means that you are in a better cash flow position because your debts are more manageable. You've got less leverage on the business, and that's why the banks are willing to do them. Right? Is because the bank's number one concern there are 3 levels of assurance when a bank makes a loan. The first level of assurance is just that the business is a profitable business that cash flows that can afford to make the debt payments, right? And so the bank wants to make sure that that is going to be a successful path to repayment. The second degree of assurance is your personal guarantee, which oftentimes is linked to the business too, because if the business can't make enough money to pay you a reasonable salary, then you're going to stop paying yourself a salary and you're going to get into more debt personally, which is going to erode the value of your personal guarantee. And the third level of assurance is the collateral, right? And the banks don't want to come and take your used delivery truck and try to auction it off and repay part of the loan because they know that that's a losing proposition every time. That's their like last line of defense. What they want is they want to make sure that they're setting you up for success so that they can then have a successful performing loan that they get to earn interest on and make money on, right? Without ever having to sue you for your personal guarantee or go collect collateral. So I've I like to say that, and I'll put another caveat on this. If the bank is one that holds its loans, then a bank being willing to finance your deal is often a sign that they see it as a good deal. A bank that sells its loans, they just originate, uh, they may not have the same interests. Anyway, I hope that was an informative video. If you think I'm nuts or you think I'm crazy or if you got a different point of view, please in the comments down below, put something. If you want to help the show and show the algorithm that's great content, put a comment down below, or share this onto another social media platform. Um, Hit the like button, of course, but the like button is more about training the algorithm about what to show you in the future. If you really want to help promote the show, put a comment because it demonstrates engagement and it really helps me out. And if you haven't already, of course, get the new book, Buying versus Starting a Small Business. Is available now. I would appreciate it if you bought the book and read the book and left a great review on Amazon. Whether you like it or not, leave an honest review because it helps everyone down the road understand if it's a good opportunity. And if you wanna learn more about putting these deals together, you know, the big mama jama, the big solution, the way to improve your skills is, of course, to head over to businessbuyeradvantage.com and do the online training there. Newly expanded this year with a couple of modules and another one on the way. Anyone who signs up at any point always gets access to any future modules that are added. So with that, I'll say thank you very much, and we'll see you next time. Yeah. So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.